Hello and welcome to MF Corner, coming to you live from our Mumbai studios. I'm Sonal Bhutra. And today we focus on how should one reallocate or rebalance their portfolios, and if one should take this move at a time when markets are volatile. This is the time when you would be thinking about it. There's so much happening, right? To discuss this and more, we have with us today Kavitha Menon, the founder of Probitus Wealth, and also joining on the show today, Anubhav Srivastava, managing partner of Aryzen Capital Advisors. Anubhav and Kavitha, thank you so much for joining in today, and it's a pleasure to have the two of you on the show, especially at a time when there are a lot of questions coming in from the investors, whether they should buy, whether they should sell. So it's a good time to understand whether there should be some reassessment of portfolios or not. So lady, let me start with you first up. The most basic question, how often should one rebalance their portfolios?
So how often should one rebalance a portfolio is a measure of whether you are rebalancing with the purpose of improving returns, or is it with the purpose of bettering or managing the risk in the portfolio? So obviously people who do tactical allocations may want to rebalance depending on their view of the market. But for most of the investors, rebalancing is done with the intention of managing risk. So how often should you do it? Because there are costs involved every time you do rebalancing. It should be as less as possible. But typically, people would do rebalancing basis their the stage in which they are in their life cycle. So typically, young individuals who have very big expenses coming up, buying a home, buying a car, they may need to rebalance a little bit more aggressively than say somebody who's in an accumulation stage of their life. They may rebalance a little less frequently or may not need to rebalance. Similarly, somebody who is during the retirement stage or closer to retirement might need to rebalance a little bit more frequently so that the risk is managed.
Okay. Anubhav, coming to you, first the same question, how often should one rebalance their portfolios according to you, and what are the different approaches to portfolio rebalancing that an investor can look at?
Hi, Sonal. So, portfolio rebalancing, ideally, if you were to look at a very efficient portfolio which takes into account whatever asset classes are available right now, then the math of it says about 8 to 9 months. However, nobody actually has those portfolios. They're all theoretical. So in my view, and again, the answer that was there earlier in the program, 3 to 6 months would be an ideal time to relook at your portfolio and take some decision on buying and selling. That would be ideal. The 3 to 6 months seems like a wide difference, but that a more volatile portfolio would be more like 3 months. A less volatile portfolio would be 6 months. Again, take into account costs, things like taxes, things like where your markets are at, and so on. Now, what are the different approaches to rebalancing? The first one is obvious. That is a returns-based rebalancing. You have returns into the portfolio, which tells you where if you have too much returns coming into the portfolio, you might want to book some profits and then move ahead from there. The second bit of it is simply time-based rebalancing, which is what we spoke about a little earlier, which is where every 3 to 6 months or 7 months or 8 months, depending on where your portfolio is at, you rebalance. A third approach is actually incorporating all of these things, which is looking at factors that are external to the portfolio or external to the markets themselves. So if your inflations are spiking, if you have a war somewhere, if something else is happening in another part of the world which is likely to affect you in the future, you then want to look at that ad hoc way of rebalancing your portfolio. Ideally speaking, you probably want to do all three.
Right, we take that point. So a lot of things that happen with rebalancing, and these are the different approaches that you can look at portfolio rebalancing as well. Kavitha, the major question that comes in that case is, does rebalancing the portfolio cost more money to an investor?
There are costs, and you do need to do a cost-benefit analysis when you're doing rebalancing. The major impact of rebalancing comes from taxation. Every time you sell something, there will be capital gain. So there is taxation involved. There could be transaction costs, brokerage. If it is buying and selling in the market, there is brokerage involved. If you're selling mutual funds, there could be loads involved. So there are transaction costs and taxation. Both of them impact decision. So you need to weigh the cost and the benefit of doing these rebalances.
Okay. So apart from when you spoke about the taxation and transaction costs, Anubhav, is there anything that an investor should keep on their radar? And are there any tax considerations to be kept in mind while you're rebalancing your portfolio?
Oh yeah, so tax can eat into your profits, especially if you're rebalancing too frequently. And that's a huge one. I do know if the markets are going to turn around in the long run, then typically rebalancing frequency should be optimized. I think the other big cost that we normally forget about is the opportunity cost. If you start to rebalance too frequently, you are going to have a problem with withdrawing too much money too fast from, let's say, an equity portfolio or the equity component of your portfolio. You're not actually allowing that bit to grow. So opportunity cost, in addition to transaction cost, which is brokerage fees, STT, taxes, etc., is the other thing that we must look at.
Kavitha, any addition here that you would like to add on the cost taxation bit that investor may be aware of, but those are some of the hidden costs that they might not keep an eye on while rebalancing their portfolios?
So certainly opportunity cost, I'm absolutely with the advisor here that opportunity cost would involve losing out on a market rally because you balanced the portfolio too early. But there are stamp duties you have to pay, transaction STT costs that you have to pay. These are very tiny bits, but at the end of the day, they do impact your overall returns. So the frequency, if it is too high, then your returns are not optimal with after taxation, after impact costs. So for example, let me tell you on ETFs, for example, you were talking about hidden costs. There is something called as impact cost that happens because the price at which an ETF is listed is not necessarily close to its true NAV. Very often ETFs are listed at a very different price. The spread between a buy and sell rate is very wide, for example. Now, this a person who's not very, very conversant with equity or with ETF investments may not be able to see the impact cost of this, may not check against the actual NAV, true NAV. There are ways to do it. So if you end up doing transactions at the wrong NAV, also you will have a major loss. So these things also you need to consider.
No, they absolutely have to be considered, but as we've been pointing out, some of them are hidden costs, right? So it's good to get that dose from the experts, what to keep in mind when you're rebalancing your portfolio. Very important chat, but we have to get into a quick break. On the other side, we'll continue our discussion with Kavitha Menon, the founder of Probitus Wealth, and also Anubhav Srivastava, managing partner at Aryzen Capital Advisors. Stay tuned for that. Welcome back. You're still tuned to MF Corner. We still have with us Kavitha Menon from Probitus Wealth and Anubhav Srivastava from Aryzen Capital Advisors. We're discussing everything about reassessing your portfolio, rebalancing your portfolio, and when and how you should be doing that. Anubhav, let me start with you this time. Does now look like a time to rebalance portfolios considering the volatile moves in markets? What is your suggestion when it comes to a mutual fund investor?
So very generally speaking, any volatile market movements is a good time to rebalance because you can get the volatility to work for you. You sell high, you buy low, and if it's a diversified portfolio, you'll always have the opportunity to buy and sell something or the other in the portfolio. Having said that, all rebalancing should be a function of your triggers being hit. And as I mentioned earlier, it's either a time trigger or a return trigger or an ad hoc trigger, which depends on external macro factors, wars, interest rates, inflation, currency movements, and so on. So while if you don't have, the bandwidth to go around analyzing all of these things, then sure, if your portfolio looks like it's getting skewed towards, let's say, equities, this is a good time to rebalance. Volatility is a factor that you should consider. The higher the volatility, it's a good trigger again to rebalance, but definitely determine what is it that you need to have as a trigger to rebalance? And as soon as those triggers are hit, you should rebalance your portfolio.
Okay. So that's, of course, as you said, it's generally speaking, a lot depends portfolio-wise and investor-wise as well. We totally take that point. Kavitha, your take on this question?
So, Sonal, in the last 1 year, we've seen, in fact, the last couple of years, we've seen a tremendous rally in certain segments of the market. Themes have done extremely well. Small caps, mid caps have done exceedingly well, and many of these segments are way above their average valuations. Generally, people think of rebalancing between asset classes. So it's either debt to equity or equity to debt. But rebalancing can also mean rebalancing within an asset class. So, supposing you are invested in equities, you can rebalance between, say, large caps and your large cap allocation and your mid and small allocations, right? Because the rally has been so stupendous, such amazing rally in small and mid cap, especially in thematic funds. If you have played thematic as a part of your satellite portfolio, then maybe rebalancing will mean getting out or booking gains from those funds which have done very well and moving them into safer investments like large caps or maybe multi caps or hybrids. So that your risk is contained or you're managing your risk better. So that kind of rebalancing can happen during these kind of markets where you've seen certain segments outperforming the rest of the market. So I think it's great to rebalance if you've done really well and your portfolio has in parts done very well, then this is the time to definitely rebalance.
Okay. So, Anubhav, say a person knows that, okay, I have to go ahead and rebalance my portfolio. Maybe there would be some costs involved. But are there some cons of rebalancing your portfolios as well, or is it always positive?
Oh, well, we've already spoken about costs and opportunity and compounding and all of that. So that's a huge problem with the rebalancing. I think the other thing that needs to be brought in here is, do you really want to catch a falling knife? I mean, you look at that whole big market movement, that 20% movement that happened when COVID hit us. And those are those exceptional scenarios where pulling the trigger too soon might be a problem. Now, which is good in theory, it is very difficult to practice. I think waiting and watching sometimes is a good practice rather than pulling your trigger too fast. And so the con to rebalancing frequently or reacting to market movements is probably a bad idea. So the big con out here, in addition to costs and opportunity cost, is that you might actually be buying things that are headed for a big fall.
Okay, so Kavitha, in that case, how can one rebalance their portfolio? What is the strategy you would suggest here?
So generally, people think of rebalancing in the way of, they have to sell an asset, the one that is doing very well, and put more money into an asset which is where the allocations have reduced because of the rally in a particular asset class. Now, this involves transactions and hence capital gains and taxes and costs. One hack that I give investors, especially those who are in the accumulation stage of their life and adding to their portfolios regularly, is that instead of selling and buying, the easier approach is to simply add more funds to the asset which is under represented and stop adding it to that asset which has done exceedingly well. So I'll explain this by an example. Let's say an investor has been doing an investment via SIPs and has accumulated, he has invested 300 rupees in equities and 200 rupees in a debt portfolio. Now, thanks to the rally in the market, his 300 has become 600 in equities. But the debt part is languishing naturally. It is just earning him a 6% return. So the portfolio is around 230 rupees. Now, his predetermined allocation was 60-40. And now, because of the market rally, his allocation has gone to 70-30. In this case, all he has to do is the fresh SIPs or the fresh investment that he does. He stops his SIPs in equity and starts doing more SIPs in the debt part. By the next 1 year, he would have accumulated enough assets in the debt allocation such that the allocation returns back to 60-40. And he can keep doing this mix match between equity and debt as and when the allocations change. So that overall his allocation is maintained at 60-40. This kind of a hack ensures that you don't have to do a lot of buying, selling. And it works for people who are in the accumulation stage. it will not work for somebody who's in a retirement stage, obviously, because they have a stagnant portfolio where there are no additions.
Okay.
But for most people, this hack works because the taxation can be managed this way. There is a second hack, which is invest in multi-asset funds or hybrid funds. These funds are managed very efficiently in various asset classes, depending on a lot of macro factors, quant factors. The allocations are, whenever they are rebalanced within the fund, you don't pay taxes because within the fund, there are no taxes to be paid and you are not exiting the fund. So there's no taxation impact.
Okay.
And you can make, therefore, multi-assets or hybrids can become the core part of any investor's portfolio.
Okay, take that point, Kavitha. So those are some strategies. Anubhav, in that case, if you can quickly tell your 3 Rs. My director tells me you don't have much time. So your strategy there. And according to you, what should the ideal mix be for a conservative medium risk versus an aggressive risk taker?
All right, perfect. So when you have to rebalance, I think let's give it a little bit more color. The first thing is you have to review your portfolio, which means that do you really need to rebalance? It's a go, no go decision. Right. So if your triggers have been hit, are they, is it necessary to rebalance right now? Can you wait for a little bit? And all of those things that we discussed earlier. So the first part is review. The second part is, and then from that review, you will either get a rebalance decision. So fine, reset it back to what it was. And you need to be aware of one thing, that when you are investing in things like, multi-asset funds or hybrid funds and those kind of things, you need to understand where those funds are investing in. Add those specific asset classes to your individual asset class allocations and then rebalance. However, there might be a scenario where there is a dislocation in the market for a medium or a long term, in which case you need to reallocate your portfolio. You might need to get away from that 60-40 example that we spoke about earlier into a slightly different example. Now, this depends on life situation. This depends on where you are at. It depends on what's happening in the market and so on. So in a nutshell, do a review. That review will lead you to either rebalance or a real reallocation of your portfolio. Oh. Now comes the question of what is an ideal mix? The rider out here is, this is very, very generic. This could be dependent on your life situation and all of that. A conservative portfolio, in my view, in India, given our inflation, given our long-term goals, where we are at and so on, is a 40% equity portfolio. The balance 60% goes into debt, it goes into metals, it goes into things like REITs and so on. A moderate or a medium risk portfolio would be your classic 60-40 portfolio, where 60% in equity and the other things go elsewhere. So, gold, silver, right, REITs, bonds, etc. And an aggressive portfolio would be a 75% plus equity portfolio. And this would necessarily include Indian equities and foreign equities.
Okay, thank you so much for that precise and insightful answer, Anubhav, on that question. Thank you so much, Kavitha and Anubhav, both of you, for taking out time and joining us on the show today. With that, we'll take your leave on MF Corner today. Stay tuned for Closing Bell to take you through the last hour of trade.